Welcome back in, ladies and gentlemen. Today we're going to break down a company that's kind of been dead money over the last 5 years. Now, as we went over before, consumer staples and healthcare have kind of been dogs, laggers, underperformers. They've just been complete trash to own. But when is the best time to own them? Well, when people get fearful, we get greedy. So we have to start looking at these names because they've just kind of fallen to the wayside. They're not exciting and they're getting overlooked, I think, by the market. And a lot of these companies have some insulated earnings, which means that if we go into a downturn, if we go into a slowdown, these are some companies that should still have some earnings power and actually hold up fairly well in a bad economy. And by the way, if you are new to the channel, welcome in, consider subscribing, smash that thumbs up. We are on a road to $100,000. I have no stock exposure right now. We're going to start slowly adding into positions. This is not a recommendation to buy or sell stocks. This is just my journey. So disclaimers, warnings, all of the above. Always recommend buying a broadly diversified index. Set it, forget it. See you in 30 years. It is a full-time job to buy stocks. And even if you make all the right decisions, management can let you down. Things out of your control can happen. And so this is strictly entertainment purposes. The stock we are actually breaking down is going to be Bristol Myers Squibb. This was once a darling stock, a very solid company, a safe haven for most dividend investors, and it's been dead money for the last 5 years. As we can see here, when we look at the 5-year low, roughly sitting right around $44 a share. The 52-week low is $48 a share, and now we're trading right around $50 a share. And if you haven't reinvested that dividend, you're probably down or possibly even flat if you bought this stock a while back. The same would be said for Pfizer, which is another stock we've covered on the channel. Now, we try to take an unbiased opinion, look at the numbers, look at the recent earnings, and formulate our own thesis on the stock. We don't buy into hype stories. We don't always take what management's saying for 100% accuracy. So let's talk about a few different things that I specifically look for when I buy a stock. Number one, whether you're a growth investor, a value investor, or a dividend investor, we all have the same objective, which means to me that we're all value investors. We want to buy a stock low, we want to sell it high. Nobody in their right mind wants to buy a stock high and sell it low. So the approach we take, number one, does this company look like it has good value compared to its peers? Does the valuation seem reasonable or cheap when we compare them to their peers? If the answer is yes, number two is to dig into the fundamentals and figure out if this company has very strong fundamentals underneath it. Is the balance sheet clean? Can they handle their debt? Cash flow and the cash on their balance sheet cover most of the debt. Do they get a high return on invested capital? Do they have a big moat or competitive advantage? If the answers are yes and this company is trading well below its peers, you probably are onto something here. Not always, but you're probably onto something. Now let's talk about why the stock price is getting depressed. It's very similar to Pfizer here. When we're dealing with those biopharmaceutical companies and things come off a patent and they don't really have a tremendous amount of optimism in their pipeline, well, the price action gets priced in because future revenue is obviously going to decline or there's going to be more competition. So they lose that moat or competitive advantage. And that gets priced into the stock. But at some point in time, there's going to be an equilibrium when even though they are kind of in the bad news and valuations are compressing, at some point in time, this could be a buy if fundamentals stay strong because they can regain that moat and competitive advantage depending on what they're doing in their pipeline, what acquisitions they're making. So you want to pay attention to kind of this back end thing, and you really want to be betting on management to execute. And that's actually the icing on the cake that I look for when I buy a company. The last objective is, do I trust management to execute? And has management showed me that they can execute? If they haven't shown me they can execute, probably best to sit back, make sure that they can do what they say, and make sure the fundamentals line up with what they're projecting out here. But just looking at top line revenue growth for 2014 to 2022, they've done $15.8 billion of revenue, now doing close to $50 billion of revenue at $46 billion, which I'm actually projecting is going to come down. We'll dig into the earnings and figure that out. We can see earnings per share is just all over the place, and this is going to be normal to see with biopharmaceutical companies. You have to realize this is almost like a cyclical business where they have great things in their pipeline, they eventually expire, they sell off, they have to invest money, and then they get good things in their pipeline. And it's just this ebb and flow of price action on the stock depending on what's going on with the earnings and what's in their pipeline. But we can see going from $1.21 to nearly $3 a share in earnings is good to see. Even though it wasn't a straight line, it is heading in an upward direction. We're looking at free cash flow now. Free cash flow is coming in nice. EBITDA margins are all over the place, so we're going to err on caution when we run our analysis here. But good margin business overall, good free cash flow, they've grown revenue, and now the stock is basically at a 5-year low. And if we go back 5 years, let's take a look at what they were currently doing for revenue and growth. So they're doing between $26 to $22 billion in top line revenue, earning between $2 to $3 a share. Free cash flow was coming in between 6 and 7 billion, and margins were sitting between 25 to 29%. Get kind of a snapshot of what past performance was when the stock was trading at a similar stock price, and we're seeing here that there could be some sort of disconnection here because the stock is obviously doing much better from a fundamental standpoint, which means that there could be underlying value, or we have to reprice everything because the market is actually thinking that they're only going to do roughly $25 to $30 billion revenue. I'm starting to think that there could be some opportunity here. Return on invested capital coming in at 12.4%. Very, very nice return on invested capital. Company's doing a good job deploying capital, which is making me confident on the recent acquisition they had. The mergers and acquisitions taking place could present some arbitrage on a lot of these companies that are buying up other companies. And so when we look at what Bristol Myers Squibb has recently purchased here, total equity value was $14 billion. They paid $330 a share in cash, so it was an all cash deal. Aruna is a biopharmaceutical company driven to discover, develop, and deliver transformative medicines for people living with psychiatric and neurological conditions. So when we take a look at the dividend history, which is important to a lot of people, we can see that 34 years of consecutive dividend payouts with 7 years of growth. Now, over the next few years, I'm not expecting them to really do much with their dividend. I think the main focus is going to be reinvesting in the pipeline, and we're going to go over their cash position because that is a little bit of a concern. So let's talk about the balance sheet of Bristol Myers Squibb. So I pulled up their quarterly report. The first thing I do want to point out here is revenue is starting to trail behind here. They're doing $33.6 billion of revenue in 9 months ending in 2022, now coming down to roughly $32.6 billion in 9 months ending of 2023, over $10 billion pretty consistently a quarter here. Bring that down to an EPS, we get $3 a share on earnings. Cash and cash equivalents have come down from 9.1 billion to 7.5 billion. The liquidity versus the liabilities here, and total current liabilities sitting right around 23 billion. So we're seeing revenue decline and liabilities are a little bit of a concern here. The question is, are they going to be free cash flowing 6 to 7 billion, or are they going to get closer to that 10 to 15 billion? Because if they're closer to that 10 to 15 billion, then obviously this debt load is not a big deal. So now what we're going to do is plug in some numbers to get a per share cost that I should be paying for the stock. Now, this is not a fair market value here. This is me building in a 10 to 12 to maybe even 15 compounded rate of return. In years 6 through 10, I will say they can get up to 30% EBITDA margins, which I think is reasonable because they've done over 30% EBITDA margins. And I think over the next 1 to 5 years is going to be the hardest time for this company. Now, I'm going to fiddle around with 2024 earnings because I have them doing $46 billion of earnings, and I don't think this is accurate. I actually think they're going to probably do closer to 35 to 40 billion dollars of revenue. As we see, revenues are declining, and they're going to do right around 43 billion, I believe, this year, maybe 43 to 45 billion. So you guys can see exactly what I did here. I'm projecting out that they're going to do just under 41 billion of revenue, then 2025 41.7, 2026 42, basically getting back to where they are today. And basically by 2027, they're going to get back to where they are today and start growing their revenue from there. Hopefully things come through the pipeline, makes better investments, and they get a better return on invested capital, and therefore that will appreciate stock price. They're still going to be buying back stock. They're still going to be paying a dividend. So there is still some strong fundamentals in this company that we still have to look at. So we get two price targets here. We get a $36 price target and we get a $54 price target. And this is me looking for an 11% compounded rate of return. And I'm willing to take a little bit of a less rate of return because I think this is a higher quality stock. The lower quality stocks or stocks I feel like I'm taking on a lot of risk, I build more safety in. But a company like this, I think, is a good buy, and I think they can actually outperform exactly what I'm printing out here. So let's average these two out to get a cost basis. We're looking at a $44.50 stock, which has hit $48. So for me, I definitely think if it gets into the mid 40s, you start averaging in. If it gets to the high 30s, I think you average in a little bit more and save one more clip in case if it gets any cheaper. And I think if it gets back into the 40s, if we see it get in the 47, 48 mark, I may start averaging in just a few shares at a time, really take my time building out this position because it's probably going to be very volatile, and I'm most likely not going to miss any massive run in it. As always, appreciate everybody's time, and we will see you in the next one.